So now all of these mortgages were packaged into mortgage securities. Now the engine that makes the mortgage world work is not banks lending their own money. That's 1960s. The engine that makes the mortgage market work are investors, and a lot of you are investors if you have mortgage-backed securities in your 401k, but investors, and it was mostly global investors. There's a lot of cash, liquidity running around the world, wanting to buy mortgage securities. So they'd buy these mortgage securities, and so we'd package these loans. You take all these loans, you package them in, poor underwriting, remember. So they're packaged in and they're sold, and each one of you might have just one little piece of it. And then you'd have big financial institutions, Bear Stearns, Morgan Stanley. Remember those guys? Remember when you remember them? Back in the good old days? But they would buy big bundles of these things, but they wouldn't just buy them. They'd buy them and borrow against them. Okay? So I might buy, let's just keep it simple, $100 worth of mortgage securities, but I didn't want to invest $100 of my own money, so I'd borrow $95 or $96 against it. Now what happens? Those mortgage securities have now gone down 40 and 50%. Okay? So if I've got 50% on the dollar, I've got 50 cents on the dollar, my $100 is now worth $50, and I'm borrowed against it to $95. What do I have to do as a company? Now mortgage, if you got a mortgage on your house, you don't have to do anything. You just get to keep paying or not. But with corporate debt, you have to, it's called a margin call. You have to bring that current, right? So I have to bring it current. So now I got $50, I got to pay it down to $45. Where am I going to get the cash to pay that back? I have to sell other assets. Okay, so I have to sell other assets. That is causing the value of those assets to go down. Remember Ruben Zubro's supply and demand. So those values are going down further because now all of these securities are being dumped onto the market. Now high quality securities dumped onto the market, causing prices to go down, 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 down. There's no more money to buy these things. All right? That's called deleveraging. Leveraging is when I borrow against something to gain leverage and gain more value for my investment. Deleverage is when I have to sell investments to unleverage myself. So when you hear people talk deleveraging, that's what they're talking about. And it becomes a spiral because the more I have to deleverage, the more I have to sell assets. The more I sell assets, the fewer buyers there are, the more the values go down, the more I have to sell assets. And that's what the Fed has been doing to try to stop this cycle, is interrupt it and keep the values of these securities to stop going down. That ultimately ended up that nobody trusted what the banks had on their balance sheets. Are you really pricing those securities properly on your balance sheet? Therefore, I'm not going to lend to you. You with me? So if I don't lend to banks, if banks won't lend to each other, that's the grease that has the entire financial system working. That's what happened about 6 months ago when this whole thing shut down. Well, no, it was what? 2 months ago. How long ago? I don't remember anymore. But it was when McCain suspended his campaign and ran to Washington. So in any case, that was what was going on, and that was the reason TARP needed to be passed, Troubled Asset Relief Program, was to find a way to stop this cycle, to get confidence back in the financial system, to keep the economy from completely collapsing. And this wasn't just the US economy. I was on vacation in France, and the French were pointing at me and laughing. And saying, you US guys sure got yourself in big trouble, didn't you? 2 days later, the French government was having to step in because the French economy was collapsing, and the Italian economy was collapsing, and the English economy, and the Chinese. It became a global problem. So that's where we stand today. Now the good news is that the investment into the banks worked. The investment needed the money, but the world needed Wells Fargo and Bank of America and Citibank and Chase to have the money because there needed to be confidence in the financial system so that banks would begin to lend to one another. And as you heard this morning, it's starting to work. A good indication is LIBOR. LIBOR, London Interbank Offered Rate, is the money that is basically the rate that banks are lending to one another. And when it drove way up high, it was bringing the financial. It was because banks wouldn't lend to each other. It seems to be healthy today. That's a good sign. So that was one thing to watch for. I'm going to give you now